I recently had the rare chance to sit down with Adam one-on-one to talk about something a little bit different, his income and dividend portfolio. So from what I've heard, this is actually the first time he's opening up about this topic publicly. And it's part of a special series of live online webinar we're running for Retail Rebellion 2025. So if you're keen to learn how Adam Khoo is building a steady stream of passive income and how you can apply the same principles, grab your free ticket from the description below and we'll see you at Retail Rebellion 2025. So Adam, I think you have been someone that is highly respected in terms of picking individual companies in the US market. But I think for myself, I've realized over the last few years at least, you have also been talking a lot about your income portfolio where you collected great amount of dividends as well. So I just wanted to ask you if you can just summarize it, what changed?
Nothing changed, but the fact is that over the years, as I grew older, my dividend portfolio became a bigger and bigger proportion of my overall wealth building process. So, of course, in my much younger years, I just focused on the capital gain portfolio. So, these are buying stocks that have huge annual return, 20-30% compounding my wealth, but they don't pay much or any dividends. Then, once I was about 40 plus years old, then I started to build my dividend portfolio. So the dividend portfolio, the objective is not so much to get capital gain, although there is some capital gain, but the main objective is to get steady stream of dividends, which is purely passive income. So I always like to say that every market is good for something. So for capital gains, the US market is the best place because the most profitable growth companies are in the US market. But most US stocks have very little dividends, and the dividends are also taxed at 30%. So it's not worth it to buy for dividends. It is to grow your wealth. So I like to say that US market is to get rich, but the Singapore market is to stay rich. And so the good thing about Singapore stocks, again, not all, but some of the good quality ones, which I own, is they pay very attractive dividend yields of 5, 6, 7, 8% tax-free, right? So from my 40s, I started to build this dividend, or call it an income portfolio. And now I would say I've got, as you guys know, I've got 2 capital gain portfolios and I've got 1 dividend portfolio. So now the dividend portfolio makes up about roughly almost 40%. So my capital gains about 60% of the wealth, and then the 40% would be the dividend portfolio.
Can you also give us maybe a bit of flavor in terms of your allocation in a particular dividend portfolio? How much you've got maybe over the last 12 months?
Yeah.
What was the decision-making process when you were building it over the last 10 years or so, I believe?
Yeah, I mean, so the main intention is to buy companies that give very consistent dividends, that grow consistently. And I mean, the great thing about it is it's purely passive, which means that if I don't do anything, I don't wake up in the morning, I sleep the whole day, the money will still come. And the day where I say goodbye and leave this earth, my wife, who hopefully will be outliving me, and whoever inherits, they will continue to get this income for the rest of their life. So it's purely passive because, I mean, my wife doesn't have my passion in trading. So I was thinking in my 40s, right? So if anything happens to me, she gets all my portfolio, but if she don't know how to trade options, she don't know how to trade, she can't get the income I get. So I have to set up something that's totally idiot proof, that she just inherits it, she sits on it, and the income just comes. For my income portfolio, almost half are in 3 companies, which is the 3 Singapore banks. I'm a big fan of the 3 Singapore banks because in my mind, they are one of the safest banks or companies in the world because they're very conservatively run and their dividend payout is very consistent. The dividends grow consistently over the long run. And right now, the yields are still attractive, right? About 5% yield, although they are selling quite above their average price to book value. So I wouldn't add more right now, which I have not. But when they get cheap once in a while, like during COVID, when OCBC sold at $7, I was buying like crazy. When DBS sold at $15, I was buying like crazy. So I like to buy a lot during mini crisis. Even during the March, April, when Trump came up with the trade war, they dropped temporarily very quickly and I quickly grab a bit more as well. So every time there's a crisis, people panic, I'll then buy the 3 banks and then hold it to get that dividend income. Another 15% comes from private credit. Private credit is also known as direct lending, but I only invest in US-based private credit funds. I've got some which are listed and some that are not listed. And very good. The yield is about 8, 9, 10% yield. And I buy the very high quality ones, so they are very consistent. They are very, very safe in my opinion. And there's no tax, right? There's no withholding tax on dividends. Then another 30% would be on REITs. And now I only, again, buy the very, very high quality REITs where most of the assets are in Singapore real estate. And then a little bit of exposure to some Hong Kong stocks that have dividends. Actually, I used to own the Bank of China, which gave very good dividends. And actually, my regret is selling it too early. I don't mind actually buying it back, but now it's a bit expensive. I'm waiting for it to come down and all that. In general, I already said I don't want to add more China exposure, but I think the China banks, especially Bank of China, is very, very safe, right? State-owned and all that, and they give very good yields.
How are you looking at a yield picture? So in terms of the capital involved, like let's say how much you put in, how much it grew until, and then how much dividends it's giving you every year.
Well, the last 12 months collected total about 370,000 in dividends.
Right. So that's roughly 30,000 a month.
Yeah, but it's not every month exactly 30,000, right? Yeah. So the yield on the market value, it's about close to 5%, right? Yield on cost is a bit hard to calculate because I buy every year. Every year I buy a bit. So for example, DBS, I've been buying for years and years. And in 2020, when it dropped to $15, I bought a lot of the three banks. I bought in equal proportions, right? But then along the way, 2021, 2022, 2023, every year I would keep adding a bit more. So it's dollar cost averaging. I keep averaging in. But I don't dollar cost average in blindly, right? I look at the chart patterns. It must drop to a support level, must be below the intrinsic value, and the yield must be attractive, then I add.
So actually, you do adopt a lot of those individual companies' philosophy when you look into picking or building your own dividend portfolio as well, right? You look at this kind of dividend companies, a few key benchmarks that you look at.
Okay, the most important thing when you buy a company for dividends is that the dividend per share must be growing consistently. That means I avoid companies that are very cyclical, where in good times they pay more dividends, bad times they cut the dividends or they can't pay dividends. No. So if you look at the three Singapore banks, for example, even during the financial crisis in 08, 09, even in COVID and all that, they still pay dividends, right? In fact, in 2020, they had to cut their dividends by half, not because they couldn't pay, but because the MAS, Monetary Authority of Singapore, told them to not pay dividends as much to conserve their cash. But actually, they could if they wanted to. So they were just being super conservative, right? And then after COVID, they made up for it. They kind of like backpaid the dividends, right? So that's what I look for, very important. And then, for example, the private credit funds that I bought, I look at how they performed during the great financial crisis, how they performed during COVID. And again, I want to make sure that in the past recessions, in the past crisis, they were still able to grow their dividends. So to me, that's the most important thing. The biggest mistake people make is that when they buy a dividend stock, they just look at the yield. They thought, wow, 10% yield, 11% yield, and they buy it. That can be very dangerous. Because sometimes the yield can be high, not because the dividends are growing. It could be high because the share price is collapsing. If the share price drop, that causes the yield to go up. So you don't want that to happen. So what is more important is not just the high yield, but the dividends per share must be growing. So I'll give you an example. Let's say stock A has a dividend yield of 10%. Wow, looks very attractive, right? But the dividends are not growing. In fact, the dividends have been declining. Okay? Versus stock B, where the dividend yield is 5%, 4%, but the dividends are growing at 15% a year, which is more attractive, right? The second one, right? So you have to look at both the current yield and the dividend per share growth rate for the last 5 to 10 years. So one of my favorites is, of course, DBS Bank. So DBS Bank, if you look at the last 10 years, if I'm not wrong, their dividend per share growth average for the last 10, 15 years is about, if I'm not wrong, it's like 12, 15% growth a year, which is phenomenal.
Actually, I do realize that through the conversations, right? Also, you talk a lot about stress testing it, especially in bad times, right? You talk about bear markets or the economy not doing well. And I think, especially for investors that are in the dividend or yield space, more or less, some of us will have some exposure to the REITs asset class. And the REITs asset class, I think, in general as a category, hasn't really been performing well, or at least it's starting to come back up. But over the last 3-4 years, they haven't been doing very well. Just wanted to know your perspective on what are you intending to add more?
So in fact, I've been adding, and last week I added even more. So the thing about REITs is that they are very sensitive to interest rates. Okay, and you notice that Singapore rates, we call it the SORA rate. So the Singapore SORA rate has really dropped a lot. That's why you see the REITs that have got significant Singapore real estate exposure, like Fraser Centrepoint Trust, CapitaLand Integrated Commercial Trust, Capital DC REIT, and Parkway Life REIT have rebounded a lot already, right? So that has really rebounded a lot. The ones that have got more overseas exposure, Fraser's Logistics Commercial Trust, Capital Ascendus REIT, Mapletree Logistics Trust, Mapletree Industrial Trust, those have been slower to rebound because a lot of their financing is based on US 10-year yield, which still has not come down as much. And the Fed, of course, still hasn't cut. Right. So once the Fed cuts, then they should rebound very strongly as well. And the other reason also they have not performed as well is because the Singapore dollar has been very strong versus the Chinese yen, Hong Kong dollar, Australian dollar. So they are depressed of that, right? So to me, all these are short-term cyclical issues. Because once currencies normalize, once the Fed starts to cut, then these other REITs would then rebound very strongly. Now, bear in mind that if I'm not wrong, there's about 50 listed REITs in Singapore. And like anything else, not all of them are high quality. Less than 10 are high quality. The other 40, I wouldn't dare to buy, right? Because they are not high quality. So like everything else, only buy the high quality ones. The ones that got very good management, the ones that act in the best interest of shareholders, and so on and so forth.
So if I can guess, you only have 10 REITs in your portfolio?
Yeah, in a way.
Actually, I just wanted to do a side detour, right? Because we were discussing about this idea of having a dividend portfolio and then having passive income not doing much. And there is always this ongoing debate of some sort in the finance literature space. They always talk about, when you look at it from a total returns perspective, why not just have a capital gains portfolio? Just let it ride all the way at S&P with the S&P or whatever stocks. And then if you need the income, you just sell out like maybe a 1, 2, 3%, and then you take the income off and just go off your way. Why bother constructing another dividend portfolio instead?
I think it's all about diversification. It's all about balance. If you go into, let's say, a protracted bear market that can happen anytime, where the bear market lasts 1, 2, 3 years, and you're totally in capital gains, then you don't want to sell at that time because you're selling at a very bad price to finance your expenses, right? But if you got your dividend portfolio, although the share price is down temporarily, you don't have to sell because you're getting the dividends, right? So same thing with the REITs. So in 2022, 2023, and even 2024, quite a lot of my REITs were down a lot in terms of the market price, right? But it didn't bother me because I was not selling, but I was still getting my dividends, right? Although the dividends was cut a bit, but still getting very good dividends. When I add up all the dividends on a total return perspective, it's done not bad actually, it's done pretty well. In fact, here's a fun fact. DBS Bank, if you add up all their dividends and capital gain for the last 10 years, they have performed as well as some of the Mag 7 stocks, that Magnificent 7 stocks like Google. It has performed as well.
I think now we will try to pivot a little bit in terms of a few of the common misconceptions, especially in this whole dividend/income investing space. I think the first and foremost one, sometimes I do hear friends or families discussing about this topic with me, and then they tell me that, oh, you should go into dividend investing. Why? Because it's safer. They think that usually dividend stocks won't fluctuate as much as your growth stocks or your capital gain stocks. What's your thought?
Totally untrue. Totally untrue. So it's not true that dividend stocks are less volatile than capital gain stocks. No. I know some capital gain stocks that are less volatile and some dividend stocks that are very volatile, right? So like REITs are dividend stocks in a way they can be very volatile. The banks can be very volatile during crisis, right? And some of my capital gain stocks, like for example, I own S&P Global, I own United Health, right? So these are more capital gain, but they can be very volatile at times as well. So that's not true. The notion that dividend stocks are safer than capital gain stocks, again, is not true. Because again, within capital gain stocks, I always say that only the top 1% are safe to own. 99% are not safe to own. They can drop and never come back, right? And same thing with the dividend stocks. I would say that in the dividend stocks universe or REITs or whatever, Singapore stocks, only 1% are safe to buy. I call them the tennis ball stocks, right? They may drop temporarily, they always bounce back. But 99% are the eggs. If they drop, they never come back. They break. Like in the past, your High Flux or your Lehman Brothers never come back, right? And again, most people can't tell the difference. They don't know the difference. That's why in the upcoming webinar, Retail Rebellion, I'm going to do a special webinar just on income investing to share with people how do you choose the highest quality income stocks that give you consistent dividends that are the safest stocks to own in that space.
Maybe moving on to the second misconception, maybe on the other side of the aisle. So on one hand, you have people saying it's very safe. Usually those are maybe the older folks. On the other hand, you have your younger folks saying that, oh, I just started out, I don't have enough capital. Let's say I have $20,000, $30,000 or even 50,000. Now it's not enough. It's a waste of time. I shouldn't go into dividend investing. What's your thoughts on this?
So, I mean, there's no right or wrong, right? So, like I said, I keep saying capital gain stocks is to get rich. Dividend stocks is to stay rich. So, I always say that it depends on where you are in your stage of life. So, if I was starting out in my early 20s and I know that I can work for many years, active income, I don't have children that depend on me yet, yeah, I don't. Why dividend stocks? True, right? I just focus on capital gain stocks. I compound my wealth. But once I reach a certain stage where I feel that, hey, I want some passive income, maybe because I'm getting older, I may lose my job, or I may choose not to work anymore, or whatever reason, then I want to start building that passive income from the dividend. So it's a whole process, not overnight. So again, maybe in your early stage, 100% capital gain, 0% dividends. Then slowly you'll be 10% dividends, 90% capital gain. And 20% dividends, 80% capital gain. So it's a progression. Now, the other thing to remember is that right now, for example, if you buy DBS Bank, you're paying about $40 per share. And you're getting a $2 plus dividend per share. So your yield is 5%. But remember that when you buy a great business like DBS, the dividends per share will grow. So from $2 dividends you grow to 30, to 40, to 50, $3, $4. Eventually the dividends will grow so much so that in the future, let's say the dividend per share of DBS Bank would be, let's say, $4. And now you're paying $45. So eventually your yield on your actual capital is 10%. So I give you an example. So I bought a lot of DBS Bank at $15 in 2020. And I keep it till now. Of course, been adding on, right? And today, again, their dividend per share is $2.20. So I'm getting $2.20 on the share I bought at $15. So my yield on my cost is like 15%. So that is the power of buying dividend stocks where the dividend per share is growing massively. So can you imagine, again, 5, 10, 15, 20 years from now, my dividend yield, it will not be 5%. It will be like 20, 30, 40%.
If I can share, I do see some other bloggers or whoever when they're building their dividend pot since early on, and people try to always reverse engineer. Somebody said that they collected $200,000 in dividends, and then if you try to reverse engineer 4-5%, you might think that the person have like a 4-5 million pot. But actually, if you've been building over the years and if you understand the concept of compounding dividends, the effective yield could have been 8-10%, but because they built it early on, that's why they're able to achieve that kind of results.
So in my webinar in Retail Rebellion, so I'll show you how do I find companies with strong dividend per share growth.
I think one maybe other misconception is I do hear people talking a lot about yield. So they focus a lot on company yield, saying that, oh, this company is paying me 8-10%. And then I do a projection out. Oh, I put in 100,000, I can get, let's say, $8,000 a year. Sounds like a pretty good deal to me. And of course, on the flip side, you have the discussion about dividend being a yield trap, because people are being trapped into some of these high yield products or even companies. How do you know whether this company is a trap or not?
So a company is so-called a trap when, again, the yield looks attractive, but the dividends per share is not growing, right? Dividends per share could be stagnant or declining. So that is why whether you buy a company for capital gain or you buy a company for dividend, it has to be a high quality company. So again, how do you know it's a high quality company, right? So that's why I've got my strict investment criteria, which I'll share in the webinar. What are my investment criteria? So for example, one of my criteria is track record. I want to make sure that the company I buy in the last 10 years, they're able to grow their revenue, profits, and dividends consistently in good times and in bad times. So I always like to see how the company performed in past crises, in past recessions. And if it could still grow their dividends, then that gives me confidence that it will be able to have the resilience in future crises.
I suddenly thought of it. Actually, increasingly, I think on forums or online, you see people starting to talk about potential recovery play or a mean reversion play. And maybe some even companies or some REITs might be trading at below book and stuff like that. I just wanted to ask personally, do you or have you been trying to play this kind of mean reversion? So other than just looking at the dividends itself, you're trying to do some sort of a capture the recovery. Have you been positioning that?
That's one style, but that's not my style. I tend to not like to go for those kind of like recovery kind of types. There's no right or wrong. Like I said, there are many ways to play the game. There's an easy way and a tough way. That's a tough way. I like to go for the easy way. I like to go for companies that are already doing well, than attempting to pick the one that is struggling and hopefully will turn around. Like everything else, whether investing for capital gain or for dividends, is about being very, very strict and very, very selective. I keep saying that in the entire market out there of companies, less than 1% are safe to invest. I call them the tennis ball stocks again. 99% are not safe enough to invest. And you have to be very strict to only stick to the 1% and not be seduced or get excited by that 99%. That may perform very well in the short term, but long run, there's not much certainty.
As we come to an end to this entire discussion, right? Just a personal, more nosy question. Just wanted to ask, so you have collected, let's say, 371,000. Are you reinvesting the dividends or are you taking out to spend? And what will your drawdowns plan?
No, I reinvest everything. At this stage, I'm reinvesting everything because I still work. I've got, many businesses and all that. So I don't need to live on that. So I just reinvest everything. Yeah.
Then do you have an ending target size that you stop? So once you hit a certain amount, or maybe the dividends get in like into the millions and then you said, I don't want to contribute to the dividend.
No, there's no end. It's like a game. Yeah. It's like the Buffett game. Yeah.
Okay.
Let's see how big it can grow. For this upcoming Retail Rebellion online event, for the very first time, I'll be doing a new webinar topic just on income investing. So for those of you who are interested to find out how I pick dividend stocks, not just in the US markets, but all around the world, come and listen to how I pick the high quality ones that can give very consistent dividend income so that you can build a passive income portfolio where in the near future you can be financially free just living on dividend income. So slots are very limited. Remember to grab your free ticket by clicking on the link in the description box below and register right now, and I'll see you at Retail Rebellion.
And I hope that you enjoyed the discussion as much as I did. And this is just a final call for those of you who have missed out. Grab your free tickets to Retail Rebellion 2025. Spots are limited and tickets are going out fast. And I'll see you there. Oh, and one more thing. If you can't get enough investment insights from our team, we have a weekly newsletter called Investing Bites, where we share short, real-world examples that help you build a better investing framework. And since you have watched until the end of the video, I'm sure you love investing as much as we do. And Investing Bites will definitely be something up your alley. So hit the link in the description below and we'll send the latest issue straight to your inbox. If not, I'll see you in the next video and more importantly in Retail Rebellion 2025. And this is CK from Piranha Profit signing off. Till next time, keep winning.